What's up, owner investor? In this video, we're going to normalize earnings for Spotify. So we're going to do the same thing that we did in the previous video with, sorry, not the previous video, but two before, like the one before the last one, with looking up the Wall Street analyst estimates, right? So the thing I'm worried about here with Spotify is, I mean, there's a pretty wild swing. Um, from 2020 to 2021 to 2022. So I just kind of want to get to the bottom of it. I mean, what it seems like what happened is the business just really aggressively reinvested into the business. And the thing is, this is like yet another thing that a lot of professional investors somehow like have not fully understood, which is because a lot of them don't actually run a business, which is why like we want to think like an operator and as an investor the costs, like the way this actually works in the real world is like companies set budgets at the beginning of the year, right? Like they decide how much to spend before they know how much revenue or sales is going to come in, right? So sometimes especially with companies that are like high growth companies, they can decide to invest aggressively in the business, but the growth might not even come in this year, it might come in over the next few years, or the growth might just not come in at all, right? Um, and so, like the decision on how much money to spend, like the costs, have to be made with a certain level of uncertainty regarding how much revenue is going to come in. So sometimes there's this mismatch between the revenue and the costs. And then what you'll see is like a lot of people, on like Twitter, saying like, oh, this company is like losing so much money. Their net income was like, minus whatever, like hundreds of millions of dollars. This company is garbage. I'm gonna like short this company. I'm gonna bet against it or something like that. Um, and that's silly, right? That's not really like you want to be a first principles thinker. Like the gap accounting just tells you what happened like in the past. What you want to understand is kind of why that happened and what might happen in the future and what's being priced into the stock, right? That's what this whole like valuation exercise is doing. So don't just look at the accounting statements and take that as like face value because again, that's just the tip of the iceberg, right? Like we want to go deeper. So with Spotify, we're just going to go again to ticker.com. So this is a great website. I'm going to contact, so the founder is actually a buddy of mine from this investing organization that I was in. And he's kind of a mentor to me, Sahil. So I'll reach out to him and see if we can get some kind of group discount once the signups grows to over like into like the hundreds or thousands. We're pretty small right now. So Spotify estimates. Okay, so it looks like Wall Street analysts are, and another thing I want to mention is like you can hover over these and it'll tell you the number of analysts that created this estimate because this is kind of an average of a bunch of it's either an average or median. It doesn't say which one they did. Um, this one's not kind of telling me. Usually, when I hover over this, it'll tell me how many people fed into it. Maybe for Spotify, they just don't have that feature. So when I was on Costco, it would tell me, oh, it just showed up, but because I'm on actuals, that's why. So when you go over to the estimates column, if you just like hover your cursor over some of these estimates, they'll tell you like the number of analysts whose estimates fed into this number that you're seeing. And I don't know if they're using a median or an average. Generally, you should do median. But this is like a pretty good number, right? Like 12 different analysts fed into that. And they're probably going to do a better job of estimating that than either me or you, at least in the near term, right? So where Wall Street analysts typically get things wrong is like more than 5 years out. And really the key skill with investing is like doing the research and then when you do have conviction in like a long-term winner, to just ride through the volatility and the swings, right? And that's usually when people get shaken out because they didn't do enough research, and that's why a lot of retail investors underperform because you um, see like some news article that's like really negative, or like some guy says something negative about the stock on Twitter or Seeking Alpha, and then you panic and you sell, right? That's why I didn't include this part at the beginning, because I could have just said like, oh, here's the valuation spreadsheet, and all we're going to do is feed in the estimates from the analysts. But the problem is like if you do that and then there's like volatility, which there is definitely going to be volatility, you're going to get shaken out of the investment because you don't actually know from first principles why you own a particular stock, right? And that's why I don't want to offer that shortcut, because it might seem like a shortcut in the short term, but it's actually going to shoot you in the foot in the long run, right? Um, that's why like you shouldn't just take the estimates. You should actually like understand what's going on. And if you end up owning Spotify, you should have that conviction of like, I think Spotify is going to get to like this many users because like of these reasons. I think they'll have this margin percentage in 10 years because of A, B, and C, and that's why I own it. And so then like when they miss a quarter, you can kind of go in, listen to the earnings call, and see, okay, is this a short-term issue or a long-term issue? If it's a short-term issue, you're going to continue to hold it. And if it's a long-term issue, you can either decide to kind of trim your position or you can get out, right? Like if the underlying like assumptions that you made that led you to the conclusion that this is a long-term winner, if some data comes in that says, hey, maybe that's actually not true. Like maybe customers don't like Spotify as much as they did, as much as we thought they did, right? Like if churn just massively increases, right? Um, and like growth slows, um, and like a bunch of artists like leave the platform, then like that thesis of like Spotify being an essential part, or whatever the thesis is, right? If that starts to break apart, then you sell. But if they just miss a quarter because they decided to overinvest and they kind of like overdid it, and the earnings numbers looks bad and the stock is down like 10%, that's not really a reason to sell, right? And if you just look at the analyst estimates and you don't understand, like you didn't watch all the videos up until now, you're going to get shaken out of the trade, and you're just going to be like hopping back and forth between all these investments, like what this analyst is saying or what she's saying, and you're just going to end up being like a day trader, which is what most people that think they're investors actually are doing, right? Including, by the way, professional managers at mutual funds and hedge funds, right? So that's again, like that's why it might seem like I'm taking this long-winded path, but I really do think this is the most effective path for you to kind of cultivate that skill of being an owner investor. So again, I'm going on all of these tangents, um, but I think it's helpful. So for Spotify, there's like 20. Okay, see, like when it gets longer term, the number of analyst estimates drops out, right? Because again, like Wall Street is very focused on like the next 3 years. And the alpha is really in like where we can outperform is thinking like more than 5 years out and doing the research and sticking to our guns, right? Um, but in the short term, the next few years, there's a decent amount of analysts that are coming in, basically saying like growth is going to slow to 13%, like a mid-teens percentage, and then kind of coming down to like 10-ish, 11%. And then they think, EBIT is earnings before interest and taxes. Just think of that as the same as the operating income number, right? So the 659 right here, right? That's the same as what we typed in, 659 right here. So that number, they have that kind of coming down and being kind of like positive starting in 2025. So yeah, I mean, it looks like they had a big investment period and then it kind of normalized out, right? So what we can do is, I mean, ideally we use quarter for the earnings calls, but I just want to quickly look up the earnings call transcript, and we can do that on motleyfool.com. Spotify. And I know there's like a lot of different resources to use, but I want to kind of show you where some of the free stuff is. So Q3 2021. Oh, geez, so they don't have the latest one. Okay, so it's a bit of a pickle. So I use BAM SEC for my earnings call transcripts, but this is something like you have to pay for this service. So maybe we just search Spotify Q4, and we're looking for the so I just go in here, but I want to help you find like the free version Q4 2022 earnings call transcript. Okay, so it looks like Seeking Alpha has it. Okay, sweet. So this is from January 2023, and this is the CEO, the founder of Spotify, Daniel Ek, just kind of talking about the quarter, right? Because we want to just kind of understand roughly like what happened here, why it seems like they lost a lot of money. Okay, cool. So right here, right, this is exactly what we're looking for. In 2021, we said that 2022 would be an investment year, and it was. And in the light of our recent news on cost and staff reductions, I'm sure some of you are wondering if we believe that that investment was a mistake, and the answer is no and yes. I still believe it was the right call to invest, and I would do it again. So, for instance, in the last 12 months, we grew our users substantially, right? Checks out, right? Because if we look at the number of new users they added, right, it accelerated from 62 million from 2020 to 2021 to 84 million, right, from 2021 to 2022. So, like we have the numbers to back up like what's being said, right? This is key, right? Like we don't want to just believe what the team is saying and just give them all the partial credit. So grow our users, enhance our capabilities, develop a better product, brought more content, tremendous sides and settings, Spotify Park. Okay. They have a more important genres, fully expect will continue videos. And in hindsight, I probably got a little carried away and overinvested relative to the uncertainty we saw shaping up in the market. So yeah, he's basically saying like, look, sorry about that. I invested a little bit too much, and maybe like stepped on the gas a little too hard. But look, like we added a lot of users, and we still like there's still a lot of benefits from these investments that will continue to reap those benefits in the future, right? This is one of the tough parts about tech companies, where this idea of like capital expenditures, which we'll get to in a couple modules, of like machinery and like property, plant, and equipment, is kind of considered like reinvesting in the business versus these tech companies where the long-term like reinvestment of the business actually comes from expenses in the income statement, right? So this is like kind of this is a big problem, right? Like the numbers become super messy for these tech companies that are like young and they're growing fast because they make investments today and then they're going to reap the benefits from those investments for many years into the future. So 1 year the earnings look like shit, but like that's going to pay off for many, many years, right? So again, this comes to like we have to understand from first principles. Otherwise, like this is just like we're not going to be able to like this might as well be in like Mandarin, right? If you're not a Mandarin speaker, or this might as well be in like Hindi or something, right? Because we're not going to understand what's actually driving these numbers, which is why like we began with the qualitative aspects, and now we're kind of taking it to the next step where we're like understanding what's happening in the short term, medium term, and long term. So he's basically saying, look, we invested a little bit more than maybe what would have been kind of like prudent, but look, like we got some benefits, and yeah. So, but going forward, we'll do with an intense, efficient focus on efficiency and that marks a pretty big shift in how we'll act, right? So he's saying, look, like I'm going to get it under control, and then it's up to us as investors to think, to believe, to do the work and come to the conclusion, like, okay, like, do we think he's full of crap, or do we believe him? And it's going to come back to like the numbers, and kind of like building like the case and building enough evidence to come to conclusions. I mean, it seems like a lot of Wall Street analysts think like they're still going to lose a lot of money in the next couple of years. But remember, like, when we looked at the Spotify K stocks, so we have them, the Wall Street estimates have them burning like, like 450 million euros over the next couple of years before they turn operating income positive, right? 450 million. And let me just find the K stocks here. My desktop is a huge mess. Spotify K stocks. If you remember the balance sheet from the Spotify K stocks, it showed that that they have like plenty of cash to cover those losses that analysts are estimating, right, for the next couple of years. You'll have your Spotify K stocks, or you can go back to BAM SEC like I did. But remember, they have 2.4 billion, 2.5 billion plus 800 million of cash and equivalents to cover those losses, right? So they can easily absorb those losses. It's not that big of a deal. So so when we kind of think about normalized earnings, right, in a couple modules, we'll start to forecast the business. That's something to keep in mind. This was not like a normal year for Spotify, but nothing to kind of like panic about. Like, it's not like the company is going out of business or anything. They have enough cash to cover the losses. That it seems like people think they're going to continue to lose money for a couple more years, but more than enough to be offset by the cash that they already have, and that they're going to continue to grow kind of in the double digits. And then in the next couple of videos, we'll decide like, okay, like what do we think they're going to grow? Like, what do we think the margins will get to? And like, what are the things that we can look at to make that determination? So that's how we normalize earnings for Spotify. As usual, post comments, questions, random thoughts in the comments below. And let's keep going. I'll see you in the next video.